Hello everyone, welcome to Property Ponderings. My name is Craig Nicol, buyer's agent at Nicol Buyer Advisory in Melbourne, Australia. Bringing to you over 15 years of property experience. I want to make sure that you make better property buying and renovating decisions and build the future that you are chasing. Today we are talking about a trap that many first-time buyers and investors fall into. The trap of doing what is easy when buying. One of the best examples of this is buying off the plan. The idea of putting down a deposit, waiting for the property to be built, and then reaping the rewards sounds very appealing and easy. But this is the easy path that can often be a red flag. In today's episode, I'm going to unpack why buying off the plan is not always the smart choice, what the potential risks are, and why taking the easy route can sometimes cost you more in the long run. So let's start by defining what we mean by buying off the plan. When you buy off the plan, you're purchasing a property that hasn't been built yet, based on the developer's plans and some glossy marketing materials. Typically, you are shown brochures, 3D models, and artist impressions. You sign a contract and pay a deposit of around 10% deposit normally, with a balance due upon completion of a project, which might be months or even years later. On the surface, buying off the plan seems straightforward and convenient, especially if you're busy or overwhelmed by the complexity of the property market. You don't need to worry about inspections, competitions at auctions, or managing an existing property. But as Warren Buffett famously said, what's easy is rarely profitable. What's profitable is rarely easy. This principle applies perfectly to off-the-plan purchases. One of the biggest concerns with off-the-plan properties is the imbalance between supply and demand. When developers launch a new project, they're often selling dozens or even hundreds of similar units at the same time. This creates an oversupply in the market, which can push prices down and make it difficult to resell or rent out the property at a competitive rate. According to the laws of supply and demand, when supply significantly exceeds demand, prices fall. And that's exactly what happens in many off-the-plan projects, especially in high-density areas. This issue is highlighted in Robert Shiller's book, Irrational Exuberance, where he explains that oversupply in real estate markets can lead to what he calls price stagnation or even a decline in property values. An example of this is in Melbourne. We can see in the inner city apartment market. Data from CoreLogic showed that between 2015 and 2019, inner city off-the-plan apartments underperformed compared to established properties, with many units seeing little to no capital growth or even losses upon resale. This is a classic case of supply outstripping demand. Investors who bought these properties were left with underperforming assets because they fell into the trap of buying what seemed easy and convenient. We can see this in articles written by major newspapers and media outlets every week, where someone's purchased a property and they've bought it off the plan, and then a few years down the track it's worth the same or less because a whole bunch of new properties of a similar ilk were built, and now there's so many of them that the prices haven't been pushed up because the demand just isn't there. Another major risk with off-the-plan purchases is market volatility. When you buy off the plan, you're essentially betting on the future value of a property. But a lot can change between signing the contract and the project's completion. Interest rates, government policies, and even broader economic conditions can all impact property values. Economist John Maynard Keynes famously said, "The market can remain irrational longer than you can remain solvent." This means that even if you're confident in the long-term value of your property, short-term market volatility can seriously impact your financial position. For off-the-plan buyers, this often means that by the time your property is completed, it may be worth less than what you agreed to pay for it. Consider the case of investors who bought off a plan in Melbourne's Docklands and South Bank in the early 2010s. By the time the projects were completed, a large number of similar properties had already flooded the market. Many buyers ended up with properties that were worth less than their contract price, leaving them unable to secure adequate financing or having to absorb a loss if they did sell. Financing is another area where buying off the plan can become problematic because the property isn't completed at the time of purchase. The final value can differ significantly from the contract price by the time it's ready for settlement. This is where bank valuations come into play. When the property is completed, your lender will conduct a valuation to ensure it matches the agreed purchase price. If the market has softened or if the area has seen an oversupply, the bank's valuation can come in lower than what you agreed to pay. This is known as a valuation shortfall. When this happens, you'll need to make up the difference with additional cash, which can catch many buyers off guard. Financial strategist Michael Yardney highlights this in his book, What Every Property Investor Needs to Know About Finance, Tax and Law. He explains the low valuations on off-the-plan purchases are a common issue that can derail the investment plans of even the most experienced buyers. Another major downside of off-the-plan purchases is the lack of control over the final product. Because you're buying based on plans and artist impressions, there is a risk that the final property may not meet your expectations. Developers can make changes to layouts, finishes, and materials during the construction phase, often without consulting buyers. This is often allowed because of the fine print of your sales contract that you've used to purchase the property. This can lead to disputes and disappointment if the end product doesn't look like what you imagined or if cheaper materials are used to cut costs. According to the Australian Bureau of Statistics, construction disputes over defects and quality issues are particularly common in high-density developments. Now, what this means for you. Buying off the plan means putting a lot of trust in the developer. Even reputable developers can face challenges, and less experienced ones may cut corners. If quality isn't up to standard, you could end up with a property that's difficult to rent or sell and requires costly repairs. And we've all heard of stories weekly on shows such as Current Affair of people that have had difficulties with trying to repair homes, townhouses or apartments after the fact and once the settlement has already occurred onto the property. One of the most important considerations for investors is capital growth. Established properties in desirable areas tend to have a better track record of capital growth compared to off-the-plan units, which often depreciate in value, much like a new car that loses value as soon as you drive it off the lot. As Warren Buffett puts it, price is what you pay and value is what you get. When you buy off the plan, you're often paying a premium for a brand new property that doesn't offer the same land or scarcity as established properties. This can limit your potential for capital growth, making it less attractive for long-term investment. Now, I'm not saying buying off the plan is always a bad idea. There are situations where it can work, such as when you're buying from a reputable developer in a tightly held suburb with very limited supply. If you have a long-term view, understand the risks, and have the financial flexibility to handle potential valuation shortfalls, then it might be worth considering. But remember, just because it seems easy doesn't mean it's the right move. As Warren Buffett advises, it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Apply this principle to property. Focus on quality assets with strong fundamentals, even if they require a bit more effort up front. Okay, that ends another episode of Property Ponderings. I hope that it has given you a few small tips to be able to make better buying and renovating decisions for your next property purchase. Remember, just because an option looks easy doesn't mean it's the best choice. Do your research, look at the long-term fundamentals and think carefully before making a move. If you want to discuss anything further from this podcast, or if you're wanting to get tailored buying and renovating advice, please feel free to contact me on 0400 122 081 or Craig at nickelbaradvisory.com.au. Information provided in this podcast is for general information purposes only and does not constitute financial, legal or professional advice. While we aim to provide accurate and up-to-date information, every property transaction and investment is unique and should seek the advice of a qualified professional before making any financial decisions. The opinions expressed in this podcast are our own and are not a substitute for tailored advice from a financial advisor or a real estate professional. We encourage you to consult with a qualified expert who can address your specific needs and circumstances.